January 24th, 2026. Silver breaks $102. Gold reaches $5,000. Bitcoin collapses below $90,000. The dollar stalls and reverses. This is not coordination. This is not correlation. This is the moment when every financial instrument in the world is screaming the same warning in different languages, and almost nobody is listening. You're watching the end of a pricing system that has governed global finance for 45 years. Not the end of money, not the end of markets. The end of the lie that paper promises and physical reality mean the same thing. And silver, of all assets, is where this truth is being carved into the ledger of history with brutal mathematical precision. Right now, as you read this, silver has entered its 5th consecutive year of structural supply deficit. 5 years. Not 5 months of temporary imbalance. Not 5 quarters of cyclical downturn. 5 full calendar years where global demand has exceeded what miners can extract from the earth. The cumulative shortfall from 2021 to 2025 totals roughly 820 million ounces, nearly equivalent to an entire year of planetary mine production, simply gone. Vanished into solar panels, electric vehicles, artificial intelligence infrastructure, and vaults that will never give it back. And in 2026, China's export constraints push effective global supply even lower, with the annual deficit expected to reach about 200 million ounces. This is acceleration. This is the moment when a slow bleed becomes a hemorrhage. The metal that was supposed to be abundant, industrial, replaceable, has become the most strategically constrained commodity on Earth. And the price is only now beginning to reflect what has already happened. The rally you see in silver is not speculation. It is not animal spirits. It is not retail investors chasing momentum. What you are witnessing is the market's delayed recognition that the emperor has no clothes, that the vaults are empty, and that every promise made in futures contracts over the last 4 decades was written with ink that dissolves on contact with reality. Let me show you what panic actually looks like. On January 1st, 2026, while Western exchanges displayed silver futures at $72 per ounce, physical bullion dealers in Tokyo and Dubai were selling at $130 per ounce, when they could find inventory at all. 80% premium, not 8%, not 18%, 80% more to hold actual metal in your hand than to own a contract promising future delivery. This has never happened in modern commodity markets. Gold occasionally sees 5 to 10% premiums during supply crunches. Silver sometimes trades at modest premiums in specific regions. But an 80% systematic decoupling between paper and physical prices? This is the sound of a market breaking in real time. Physical silver pricing on the Shanghai Gold Exchange has decisively broken away from Western paper benchmarks, with premiums reaching approximately 12 to 13% above LBMA spot and COMEX futures prices. Not 12 basis points, 12 percentage points. In Japan, premiums on secondary market platforms have surged to around 60%. The physical market is asserting price leadership over the paper market, and the paper market is losing. This is not a regional anomaly. This is not currency fluctuation. This is the moment when the global pricing mechanism fractures into 3 separate islands: Asia, North America, and Europe, each fighting over whatever metal remains within its borders, unable to trust that silver over there will ever arrive over here. The arbitrage that should equalize prices across markets has collapsed because the freight costs, insurance premiums, and most importantly, the time delay required to move physical metal have become greater than the paper price differential itself. The global silver market has split into 3 islands: Asia, primarily China and India, North America, centered on COMEX, and Europe, centered on LBMA, each fighting over whatever metal it can control. Now, we need to talk about what these premiums actually mean in the language of finance. When physical silver commands an 80% premium over futures, the market is telling you that a contract promising silver in 90 days is worth 45 cents on the dollar compared to the metal you can touch today. Think about what that means. Think about what happens to a financial system where derivative contracts, the instruments that are supposed to derive their value from underlying assets, trade at less than half the value of the physical commodity. That is not a market. That is a slow-motion default dressed up as price discovery. Between early and mid-January, in just 7 days, 33.45 million ounces of silver were physically withdrawn for delivery from COMEX, representing roughly 26% of registered inventory disappearing in a single week. This is not normal market activity. This is a run. This is what happens when institutional players who have spent years trading paper suddenly realize they need to convert promises into metal before the music stops. In COMEX, registered inventories have declined over 70% from their 2020 peak, dropping from 346 million ounces to just 82 million ounces by late 2023. And the bleeding has only intensified since. The London Bullion Market Association vaults, the clearinghouse for global silver, have seen eligible silver inventories plummet to record lows of approximately 155 million ounces in early 2026. Shanghai inventories have fallen to their lowest level in a decade. At current consumption rates, some industrial regions have barely 30 to 45 days of accessible silver reserves. 30 days. 1 month between operational continuity and supply chain paralysis for industries that cannot function without this metal. And here is where the story becomes truly dangerous. Silver lease rates spiked to an unheard of 8% in January 2026, indicating that industrial users are so desperate for physical bars that they are paying massive premiums just to borrow the metal temporarily. 8% annualized to rent silver. In years of ample supply, 1 month silver lease rates typically sit around 0.3 to 0.5%. When someone is willing to pay 8% just to borrow silver to ensure timely delivery, that is not a market signal. That is a distress beacon. That is the cost of existential risk. When having no silver is more lethal than any price you might pay for it, price discovery has failed. The market is not clearing, it is rationing. And the futures curve itself has flipped into a configuration not seen in over 40 years. The front-month silver contract is trading about $2.88 higher than later contracts, marking the steepest backwardation since 1980. Backwardation. The word sounds technical, academic. But what it means in plain English is this. The market is willing to pay more for silver delivered today than for silver promised 6 months from now. That is the opposite of how commodity markets are supposed to function. Normally, futures trade at a premium to spot prices because you have to account for storage costs, insurance, financing. When that relationship inverts, when immediate delivery commands a higher price than future delivery even after accounting for all carrying costs, the market is telling you that time itself has become the enemy. Every contract through late 2026 is trading below the current spot price. This is not a temporary quirk. This is not a 1 month anomaly. The entire curve is inverted. The market does not believe that 6 months from now, 9 months from now, 12 months from now, there will be more silver available than there is today. The market believes the opposite. The market believes that every day that passes makes the metal scarcer, more valuable, more impossible to obtain at any price the paper contracts are currently quoting. This brings us to the most dangerous signal of all. What caused this? For decades, global silver price discovery was firmly controlled by futures traders on the New York COMEX and the London Bullion Market Association, with trading volumes in paper silver dwarfing the total stock of above-ground silver, at one point reaching as high as 356 to 1. 356 ounces of paper silver traded for every 1 ounce of physical metal in existence. The system did not collapse because of one simple assumption. Nobody would ask for delivery all at once. In early 2026, that assumption failed. What you're watching is not a rally in silver. What you're watching is a credit crisis in the paper-silver system. The promises are being called. The contracts are being stood for delivery. And the vaults do not contain what the ledgers claim they contain. On January 1st, 2026, China implemented new export restrictions that changed everything. Under the new policy, only large, state-approved companies will be allowed to export silver, and only after obtaining special government licenses, with requirements including annual production capacity of at least 80 tons. These requirements effectively block hundreds of smaller and mid-sized exporters who have long served as key suppliers to global industrial users. And China currently controls between 60 and 70% of the world's refined silver supply. Read that again, 60 to 70%. China's move effectively ring-fenced nearly 65% of the global refined silver supply for domestic use, leaving Western markets in a desperate scramble for remaining stocks. This is not trade policy. This is strategic resource nationalism. This is China looking at its solar panel industry, its electric vehicle industry, its semiconductor industry, its artificial intelligence infrastructure, and deciding that silver is no longer a tradable commodity, but a national security imperative. And they are not wrong. Throughout 2025, industrial and retail demand for silver pushed prices toward $80 per ounce for the first time in history, with inflows into silver ETFs surging, while demand from solar panels and EVs tightened the physical market to an unprecedented degree. The energy transition is not coming. It is here, and it consumes silver at a rate that has no historical precedent. Photovoltaics alone are devouring unprecedented silver tonnage. Each solar panel requires silver. Each electric vehicle requires 4 to 5 times more silver than a traditional internal combustion vehicle. Every data center powering artificial intelligence requires silver in the electrical contacts that cannot overheat, cannot fail, cannot be substituted with cheaper alternatives. But here is what the market does not yet understand. Most silver comes as a byproduct of other metal operations rather than dedicated silver mines, primarily copper, zinc, and lead. This means even if silver prices double or triple, Miners cannot easily increase supply because their operations are driven by base metal economics. This dependency creates a market timing problem where silver supply increases or decreases based on base metal demand cycles, not silver demand fundamentals, with the capital-intensive nature of mine development requiring 5 to 7 years of development time. 5 to 7 years. That is how long it takes to bring a new mine online, and silver mine output peaked in 2016 with total global production around 900 million ounces, falling to an estimated 835 million ounces in 2025. Production is declining even as demand explodes. The decline in supply is due to ore grades falling at many mature operations, with closures across major producers in Mexico, India, Russia, Bolivia, Kazakhstan, and Peru. The deficit cannot be closed with higher prices. The deficit cannot be closed with better technology. The deficit can only be closed with time, and time is the one commodity that cannot be purchased at any price when industrial production lines are shutting down for lack of material inputs. This is where the system breaks. Because silver is not just an industrial commodity, it is also a monetary metal. It is also a store of value. And right now, at this exact moment in history, those three identities are colliding in a way that destroys the logic of futures pricing entirely. In just the first half of 2025 alone, silver-backed exchange-traded products absorbed about 95 million ounces of metal, pushing global holdings to 1.13 billion ounces. The largest of these ETFs now holds roughly 15,443 tons, more than 7 months of global mine output. Once silver is vaulted to back ETF shares, it is effectively removed from circulation. It cannot be lent out. It cannot be borrowed. It cannot be delivered to meet industrial or futures market needs. The result is a double-sided squeeze where factories need metal to operate, and investors are hoarding it as a store of value, and both groups are bidding for the same shrinking pool of deliverable silver. This is not a temporary imbalance. This is two structural megatrends, deindustrialization and currency debasement, meeting at the same choke point at the same time, with no mechanism to resolve the conflict except price. And price is about to do something that will shock everyone who thinks they understand markets. Now we need to talk about what is not rising and why that absence tells you everything. Bitcoin, the supposed inflation hedge, the digital gold, the decentralized store of value immune to government manipulation, is trading near $89,000, down 28% from its October 2025 peak of $126,000. It faces $600 million in liquidations amid risk-off sentiment, with sideways trading between 88,500 and 90,500 likely short-term. This is not a minor correction. This is a complete reversal of the narrative that has driven cryptocurrency adoption for the last 5 years. Gold is at $5,000. Silver is at $102. Both are making new all-time highs daily. And Bitcoin, which was supposed to be the apex predator of alternative assets, is bleeding capital at a rate that suggests something fundamental has changed in investor psychology. What changed? The realization that when you need to take delivery of an asset, when you need to settle in physical reality rather than digital promises, Bitcoin is just another form of paper. You cannot take delivery of Bitcoin in the sense that matters when the financial system is under stress. You can transfer it between wallets, you can move it between exchanges, but you cannot hold it outside the digital infrastructure that defines its existence. And when that infrastructure itself becomes a source of counterparty risk, when exchange collapses, regulatory seizures, and network failures become not hypothetical but historical, Bitcoin stops behaving like digital gold and starts behaving like a leveraged bet on the continuation of the current system. Silver, by contrast, is being designated as a critical mineral by governments, elevating its strategic importance beyond traditional commodity economics and creating premium valuations for domestic production. Russia moved first in 2022, and in early 2026, China's reclassification of silver as a strategic material is forcing institutional investors to demand physical delivery. When governments start hoarding an asset, when they start restricting its export, when they start treating it as a national security priority rather than a tradable commodity, that asset ceases to function as a normal market. It becomes geopolitical leverage. It becomes monetary power in physical form. And the dollar? The US dollar index stalls around 98.26 to 99.5, down 0.6% weekly, but rebounding from lows after Trump's softer EU tone at Davos, facing resistance with weakening momentum and bearish divergences. The dollar is not collapsing, but it is not strengthening either. It is trapped in a range, unable to rally despite every reason it should. Economic resilience, Fed independence rhetoric, safe haven flows during global instability. Why? Because the dollar's strength was never about the fundamentals. It was about the absence of alternatives. And what silver at $102 is telling you is that the alternatives have arrived. Not Bitcoin, not Ethereum, not decentralized finance protocols that require electricity and internet access and regulatory permission to function. Physical metal, ancient, boring, unsexy, industrial silver that you can hold in your hand and that no government can print, no exchange can freeze, and no hacker can steal through a compromised private key. The divergence between gold, silver, Bitcoin, and the dollar is not telling you which asset is winning. It is telling you that the asset classes themselves are being reclassified in real time. Gold and silver are being upgraded from commodities to strategic reserves. Bitcoin is being downgraded from digital gold to risk asset. The dollar is being revealed as neither strong nor weak but irrelevant to the question of where value will be stored when fiat currency itself is being debased at a rate that makes nominal yields meaningless. And this is where the narrative becomes inescapable. President Trump's threats of 10 to 25% tariffs on European nations over Greenland purchase opposition sparked safe haven rushes into gold and silver while hitting Bitcoin and stocks. Investigations into Fed chair. Jerome Powell, including a criminal probe over headquarters renovations, erode confidence, boosting gold and silver as hedges against fiat risks. These are not normal headlines. These are not business as usual policy debates. This is the world's reserve currency issuer investigating its own central bank chair for potential criminal activity while threatening economic warfare against military allies over territorial disputes in the Arctic. This is what regime change looks like before historians write the books about it. This is what currency crisis looks like before the exchange rate collapses. This is what happens when the institutions that have guaranteed monetary stability for 75 years reveal themselves to be political, fragile, and captured by forces that have nothing to do with sound money or financial stability. And silver, the metal that nobody was watching, the metal that was too cheap to matter and too industrial to be monetary, is where the truth is being written in $100 per ounce ink. Silver has been running a structural supply deficit for 5 consecutive years, with demand from industry, investors, and other uses continuing to exceed what miners can produce. Analysis of the silver market is increasingly focused on physical balances, with the market navigating a period where industrial consumption continues to outpace mine supply, resulting in a 5th consecutive year of market deficit. And the cumulative effect of those deficits is that above-ground stockpiles, the inventories that were supposed to provide a buffer during temporary imbalances, have been systematically drained to the point where there is no buffer remaining. What happens next is not a mystery. It is arithmetic. When a market runs structural deficits for 5 consecutive years, when inventories fall to 30-day coverage, when lease rates hit 8%, when physical premiums reach 80% over paper, when futures backwardation extends through the entire curve, there are only 3 possible outcomes. First, price explodes upward until demand destruction occurs. Silver reaches levels where industrial users substitute alternative materials, and where investors sell holdings to take profit, where enough supply is mobilized from private hoards and recycled material to rebalance the market. Citigroup forecasts silver could reach $100 per ounce by March, and potentially $110 by the second half of 2026, while BNP Paribas sees $100 as possible by year-end. Some analysts suggest scenarios of $100 to $200 by early 2026. These are not fringe predictions. These are major financial institutions repricing an asset class based on supply-demand fundamentals that were visible years ago but are only now being reflected in market prices. Second, the futures market breaks entirely. Cash settlement replaces physical delivery. COMEX and LBMA admit they cannot fulfill delivery obligations and force contract holders to accept currency instead of metal. This has happened before in other commodities. It will happen again. And when it does, the entire pricing mechanism that has governed silver for 45 years will be revealed as a confidence game that functioned only so long as nobody asked for their money back in metal. Third, a 2-tier market becomes permanent. Physical silver trades at one price in regions that have it. Paper, silver trades at a discount in regions that don't. The Shanghai Gold Exchange becomes the global benchmark for silver pricing, displacing COMEX and LBMA permanently. Western financial institutions lose control of price discovery for a critical industrial and monetary metal, and the geopolitical implications of that loss of control ripple through every assumption that underpins dollar hegemony, Western financial dominance, and the architecture of global trade. Which scenario will occur? All 3 at once. This is not a prediction. This is pattern recognition. The silver market disconnect of 2026 represents the first major failure of a paper-based pricing mechanism for a critical industrial and monetary commodity in the modern era. The key takeaway is that price and value have officially diverged. The digital number on a screen is no longer a reliable indicator of the cost to acquire the physical asset. We are entering a period where the word price itself loses meaning because there is no single price. There is only the question of what you can actually obtain, where, and for what consideration. The implications are staggering. If you hold cash, you are holding a claim on currency that is being printed at a rate that guarantees its purchasing power declines faster than any interest rate your bank will pay you. If you hold silver ETFs, you are holding a claim on metal that may or may not be deliverable when you need it most. If you hold futures contracts, you are holding paper promises from institutions that have already demonstrated they cannot fulfill those promises in size. If you hold Bitcoin, you are holding a digital asset whose value proposition was supposed to be independence from the traditional financial system, but which in practice functions as a leveraged bet on that system's continuation. And if you hold physical silver, you hold an asset that governments are treating as strategic, that industry cannot function without, that investors are hoarding as monetary insurance, and that cannot be produced in sufficient quantities to meet demand at any price the futures markets are currently quoting. The metal that was too cheap to matter is now too scarce to obtain. The asset that was supposed to be industrial is being reclassified as monetary. The commodity that traded with 99% correlation to copper is now trading with 95% correlation to geopolitical chaos. This is the final verdict. We have crossed a threshold. We have entered a regime where the old rules, the rules that said paper and physical were interchangeable, the rules that said futures prices determined spot prices, the rules that said central banks controlled currency value and markets discovered commodity prices, those rules are dead. They died quietly, without announcement, without ceremony, while everyone was watching Bitcoin and arguing about tariffs and debating whether the Fed would cut rates in March or June. On January 14th, 2026, the United States Mint took the unprecedented step of suspending sales of all silver numismatic products, citing an inability to source physical metal at costs that align with its currency-denominated pricing. The government that issues the world's reserve currency cannot obtain enough silver to mint commemorative coins, not because silver doesn't exist, but because the price it is willing to pay no longer reflects the price at which holders are willing to sell. That is not a market. That is a siege. That is the sound of a system under stress that has run out of marginal solutions and is about to discover what happens when the margin becomes the main event. Time is now the enemy. Every day you wait to convert paper claims into physical assets is a day when the gap between paper price and physical availability widens. Every week of dollar strength is bought by selling future credibility. Every month of Bitcoin stability is financed by retail hope that the next leg up is coming, even as institutional money exits through the fire escape. Silver at $102 is not expensive. It is mispriced to the downside by a factor that will be obvious in 6 months and catastrophic to have ignored in 12 months. The question is not whether silver will reach $150 or $200 or some number that sounds absurd when you first hear it. The question is whether there will be any physical silver available for purchase at any paper price by the time the market finishes repricing 5 years of accumulated supply deficits in 5 months of panic buying. This is not a rally. This is the end of a lie. This is the moment when paper loses its claim to represent reality, when contracts cease to be enforceable, when the word price loses its meaning because there are no sellers at any price the buyers can afford to pay. You are witnessing the silver market entering panic mode. And panic, unlike price, cannot be printed.